Hello and welcome to Swissquote's Daily Market Talk. It's Monday, September 16th, and we are heading into a busy week with major central bank decisions. The Federal Reserve, the Bank of England, and the Bank of Japan will announce their latest monetary policy decisions this week. The Brits and the Japanese are expected to remain seated on their hands, but the US Fed will certainly lower its interest rates this week. But by how much is the million-dollar question. So here we are, guys. It's the week the Fed will most probably start cutting its interest rates for the very first time since 2020. A rate cut is fully priced in by the markets, but investors can't really agree on the size of the cut that the Fed should deliver this week. Some, including myself, will think that a 25 basis point cut would be appropriate to start cutting the interest rates in the US as inflation there is cooling, but core inflation came in slightly higher than expected last week on a monthly basis, remember? Then, while corporate earnings last quarter were quite robust, mind you, growth in the Magnificent Seven earnings actually slowed from very strong to, well, somewhere very strong, and the remaining S&P 493 earnings growth turned positive, and that for the first time since 2022. Then the US GDP printed a 3% growth in the second quarter, and Atlanta Fed's GDP now forecast suggests that, well, the US economy may have grown nearly and more than 2% in the third quarter. And, well, the labor market in the US cools, but the cool down isn't alarming. Alarming would be, a series of NFP reads between 50 and 100,000 job additions and unemployment rate near 4.5%. And we are not there just yet. But note that there is a second camp of investors out there, those who believe that the Fed should start cutting by 50 basis points right away because they think that the Fed should have cut its interest rates already in July, and that it may have fallen behind the curve by not doing so, and that to make up for that delay, they should deliver a 50 basis point cut this week. Otherwise, the economic slowdown in the US would accelerate and push the US economy into a recession. Now, I believe that if that's the case, well, there is something that the US Federal Reserve officials know that we do not know, because the data today, well, doesn't look alarming at all. Anyway, the second camp gained confidence late Friday, mind you, and the probability of a 50 basis point cut from the Fed this week outpaced the probability of a 25 basis point cut. So the S&P 500 closed last week a touch below its all-time high level after recording a 4% rally over last week. The Nasdaq 100 gained more than 6%. And the Dow Jones Industrial Index rallied more than 2.5% and also closed last week at a spitting distance from an all-time high level as well. So yes, it would be surprising to see the Fed come in and deliver a jumbo size rate cut under these circumstances. The Fed usually likes actually guiding the markets and investors toward where they want to go to avoid like big surprises and high volatility. But this time around, well, the possibility of a 25 or a 50 basis point cut is really close to a coin flip. So I can't tell what they will do exactly, but I can tell you that there will likely be some good volatility in the coming days, especially after the Wednesday's policy decision. Now, in the FX markets, the rising bets of a 50 basis point cut from the Fed continues to weigh on the US Treasury yields and the US dollar. As such, the US 2-year yield is under a decent pressure below the 3.60% level this morning, while the US 10-year yield settles at 3.65% at the time I'm talking here. Gold closed last week at a fresh all-time high level and is pushing higher again this morning in Asia, as the US dollar actually kicks off this new week under a decent selling pressure across the board. Elsewhere, Bitcoin retreated during this weekend, and that even after just another assassination attempt on Donald Trump during this weekend. Then The euro dollar flirts with the 1.11 mark as, remember, the European Central Bank cut its interest rates for the second time this year last week, but its chief, Christine Lagarde, didn't let slip a word regarding what the European Central Bank is planning to do next. Cable, on the other hand, extends its gains above the 1.31 level as the Bank of England is expected to maintain its interest rates unchanged when the policymakers meet this week in London, as British policymakers made it quite clear at their latest monetary policy meeting, where they actually cut the rates, that they are not planning to embark on a series of interest rate cuts in the UK. In Japan, which is on holiday today, the dollar yen fell to the lowest level since December, and that despite the expectation that the Bank of Japan won't increase its interest rates this week after its last increase sent shockwaves across the global financial markets. So the Japanese policymakers are rather expected to wait until December or maybe even until January before they deliver another interest rate hike in Japan. So if that's the case, well, the dollar yen's destiny will remain in the hands of the Federal Reserve. So if the Fed delivers a 50 basis point cut this week, we shall eventually see the dollar yen move sustainably below the 140 level. But if the Fed is satisfied with a 25 basis point cut this week, then the dollar yen should see support at the 140 level. And the dollar is not only losing against the major peers, mind you, it is also weakening everywhere. Asian currencies, for example, have outperformed the greenback this quarter, and that including the troubled Chinese yuan. And even the Turkish lira is stronger against the US dollar this morning, to tell you how the US dollar is soft and weak into the Fed's decision this week. In the energy markets, the week starts on a weak note as well. US crude tested but failed to clear the $70 per barrel offers last Friday and is under a decent selling pressure this morning in Asia, and that's due to just another set of bad news from China, because the latest economic data from China suggests that retail sales there grew slower than expected by analysts in August, but more importantly, the industrial production grew slower than expected, and home prices fell more rapidly than the month before, and that despite the Chinese government's efforts to stop bleeding. And as Japan, China is closed for bank holiday today, so we don't get to see the CSI react to the news, but the Hang Seng index is slightly lower at this morning's trading session, while the CSI 300 index in China sank to the lowest level since February last Friday. And it's not a surprise really, because foreign investors are pulling away from China. In numbers, foreign investors pulled out a record amount of 15 billion US dollars in the second quarter on belief that the government doesn't do enough to boost growth in China. And while the Chinese technology giants hardly find investors as well, Nasdaq's Golden Dragon China Index, for example, continues to diverge from Roundhill's Magnificent 7 ETF. And even the increasing speculation that China must intervene to break the vicious cycle of weakening, does little to encourage investors to put their money back into the country. But coming back to oil prices, crude oil continues to suffer from these Chinese weakness, and even the rising bets of a 50 basis point cut from the Fed this week weren't enough last Friday to send the price of a barrel of US crude above the $70 per barrel psychological resistance. Now, trend and momentum indicators remain comfortably negative right now as we enter the new week, and the RSI index hints that oil is not in the oversold territory just yet, suggesting that we could actually see a further weakness in oil prices in the coming days. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.